Alibaba's demise never seems to catch a break. In latest news over the past week or so, we've learned that Alibaba has significantly revamped its management strategy as well as its plans to spin off its artificial intelligence cloud business. The once most valuable Chinese company has been surpassed by a host of new startups from the country, particularly those led by Temu and Pinduoduo, with a market cap loss of more than $400 billion since 2020. So what exactly can the company do to restore its business prospects? And is there opportunity for investment in Alibaba shares, which just hit a near 52-week low? Well, folks, that question is exactly what I want to try to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, folks, let's first break down Alibaba's fiscal Q2 earnings report for 2023, which fell basically right in line with most analyst estimates, yet resulted in a stock price reaction of more than 8% to the downside. When it comes to testing the patience of most retail investors, there really is no better stock than Alibaba. From the times of 2021, when people were calling Alibaba essentially a shell company and really having no real access to the business in China, through to 2022, when people were concerned about Alibaba's growth and lack of profitable growth. The stock has now since rebounded towards the downside, despite a significant recovery at the start of this year to near the 52-week low of $60 a share. And this latest rout comes in the same context of Temu.com's parent company Pinduoduo now officially surpassing the market cap of Alibaba at almost $195 billion. And in my opinion, folks, this right here is an extremely significant development in the history of Chinese e-commerce. Because for the very first time since the tech crackdown started at the end of 2020, we're seeing a Chinese company, and ADR as a matter of fact, outperform most mid-cap companies in the United States and essentially pull a full V recovery from the crash we saw following 2020. This, folks, is a clear sign that markets are not being held back by the Chinese economy or whatever the Chinese government is saying. Instead, it's being held back by simple devaluation, misunderstanding of business strategies, as well as a lack of long-term focused leadership. All these factors come together to create negative sentiment for US investors who don't fully understand what's going on offshore. And this validates the fact that being a Chinese company or being a shell VIE entity is not what is holding back the valuation of a stock like Alibaba. Instead, as seen by the success of a bargain retail platform like Temu, especially in the United States, the economy in China, as well as innovation and foreign investment, is skyrocketing at a historic pace, even amidst a slower than expected recovery of the Chinese mainland economy. In its latest earnings report, Alibaba reported year-over-year revenue growth of more than 9%, with net income growth of just around 34%. For a company that many people crossed out for its lack of growth, that is an extremely impressive result, because as we all know, Alibaba is the biggest e-commerce infrastructure as well as services provider in China, with more than 80% of all retail businesses in the country using some form of Alibaba technology. What's more is that cloud intelligence, which is the business many people are betting on with Alibaba, has performed the worst in the latest quarter with revenue growth of just under 3%. This pales in comparison to Taobao, international commerce, local services, and even digital media and entertainment, which are growing in almost all of double digits. The first and probably most important thing that this kind of breakdown does is make you realize that cloud computing is not the most important metric for Alibaba's success. Instead, the company's record free cash flow that it has achieved over the past 2 consecutive quarters is mostly attributed to its legacy businesses in e-commerce, services, as well as trading. This makes it abundantly easier for the company to maintain market share at a time when competitors are eating the company's lunch in other sectors, particularly like cloud computing, which just so happens to be a lot easier to start up and fund than any other type of company. This paired with the fact that Daniel Zhang, who was a former CEO of Alibaba, is the initial person who led the charge for the company's cloud computing business, is the reason why it makes sense they are forgiving the idea of making that business unit go public in the United States. It makes much more sense for the company to keep that $40 billion market valuation within the doors of the company and prevent any sort of extra regulatory scrutiny dismay that company's ambitions. And what makes the situation even more interesting is that unlike Pinduoduo, whose company's market cap just surpassed Alibaba's, this company makes money from a lot more diverse sources, although yes, Chinese commerce is still a majority of it. Where Pinduoduo gets taxed on essentially every step of its online marketing services and transaction revenues, which barely return positive cash flow or growing net income, Alibaba's business is much more poised to return shareholders value because of its vertically integrated nature of providing the software, the back-end platform, as well as both consumer-to-consumer and business-to-consumer solutions. Now yes, this certainly makes Alibaba's profit margins much worse compared to its nearest competition because obviously they're acting much more like the middleman instead of the full B2C solution suite. But even at its current valuation and current profitability numbers, the stock and the company's valuation in and of itself is still trading at a ridiculous discount. As a matter of fact, after the passing of Charlie Munger, his holdings in Alibaba and Bank of America have come under the spotlight because he happened to be one of the biggest names in the US buying and believing in Alibaba's business strategy when everybody else was hating on the Chinese economy. And there's really good reason for that. Because not only is the company currently trading at a PE ratio of only 10, which is way below even the 15 PE ratio we saw in 2015 when the company's revenue was 40% of what it is today, but the company's free cash flow metric has continued to go down and down compared to where the company is trading right now, with even the low of 21 being surpassed significantly right now with levels of 7.4 on a price to free cash flow basis. Has Alibaba's profit margins and growth slowed down over the past 5 years? Absolutely. But has the company's free cash flow and valuation become more attractive? Absolutely. And just like Peter Lynch says, stocks that he bought at 12 went to $2, but they ended up going to $30, which is what actually matters. Just like with the success of the biggest names like Meta and Nvidia in 2023, there's a really high likelihood we see a good and attractive turnaround story in the story of Alibaba to at least levels that the company could be fairly valued at. What do you guys think? Is Alibaba an attractive opportunity right now, or are you staying away from Chinese equities as a whole? Let me know your thoughts down in the comment section below, folks, and thank you very much for watching.